All right, fantastic. Hello, welcome to our November 3rd, 2010 Forex training. This is an FXDD every co-promotion. Very glad that you could join us here today. Our disclaimer is we do not give buy, sell, or hold recommendations. Trading is you want to make sure you trade only with risk capital that will not affect your lifestyle. All right, another one in the series of our Forex, anticipating the Forex trends, money management and Forex trading. All right, so I'm Sean Powell, one of FXDD's national trainers. I'd like to introduce you to Greg Michalowski. He's our FX Vice President, Chief Currency Analyst at the company. Many of you from his speaking gigs around the world. You can get him at .com at GregMikeFX, also a regular hoster and commentator at FXStreet.com. Now, a little bit about FXDD. We are one of the Red Bull team sponsors. We current promotion going each time the car wins or does well, or finish a pole position, you can get an 8% bonus in your account. You can get all details at FX.com on the Farming site. You see everybody's got a race coming this weekend.
My name is Greg Michalowski, and to the argument that most of you are probably preparing a little bit for manage the market, but most of this money management. Money management, to me, has two parts to it. One is that a good trader, a successful trader, you allow losing trades to accumulate. I have so many people within the retail foreign exchange market come to me and say they started up an account with 10,000, they had it go to 8,000, and they don't seem to think that that's bad a deal. And the move to 8,000 was perhaps on just a few trades where they messed up on the trade. And this though is a killer for a lot of retail traders. It's a killer for a lot of people who are inexperienced with the market. And so proper money management is very, very important. And in order to define risk, what I suggest is that you trade near key technical levels. Technical levels allow you to define your risk. They allow you to determine where the market is bullish and where the market is bearish. And I have an example here. This is the euro versus US dollar. And I'm I'm an experienced trader in that I've been doing it for 25 years now, and through those years I've learned a lot about technical analysis. But what I've done through the years is realize that too many technical indicators can actually confuse a trader, and also that if you have used technical indicators that what I consider ambiguous, that is, they don't give you a true, it's bullish or it's bearish signal, then that can also get you in trouble as well as it increases your fear. And what I mean by that is that if we look at this chart here, we have this blue line. This blue line represents the 100 bar moving average. Now we happen to be looking at a 5-minute chart, but this can be used on an hourly chart and used as a daily chart as well. And an unambiguous trading tool like a moving average can tell you that if the price is above the line, it's bullish. If the price is below the line, it's bearish. So that's one of the tools that I use in analyzing the market. I know exactly what the bias is by looking at the line, looking at the price, determining price. And if the market follows those moving average lines, like the 100-bar moving average, like it bounced off here, like it bounced off here, like it bounced off here, and then eventually moved through here and moved above here and bounced off here. You don't have to know what the lines are, but you can just see that the market follows these lines along the way, and it worked here, it worked, came down through here. We found support here and moved. It tested the level here and moved down. So you can see, from the example, and this is the current market, that at times these moving average lines tend to work. The other thing that I use is a Fibonacci retracement, and I have a Fibonacci retracement in here. This goes from this low to this high, and then we start to have a correction. And the Fibonacci retracement gives you these lines: 38.2, 50%, 61.8%. Those are the lines that I use, and those levels are also borderline levels as well. So these levels allow a trader to trade at what I consider low risk trading levels where risk can be defined. And if you can define your risk and limit your risk to a small amount, put your two fingers together, your thumb and your index finger, make them really close, and that's a small amount, you have the potential to have a oversized gain. And so what we see here, just as an example, in analyzing the market here is when the market started its move to the upside here, moved above the 100 bar. This is, by the way, the 200 bar moving average, and they are simple moving averages on your MetaTrader. If you just right click on it, you can see that it says 100 simple. It's on the close and it's blue. I put it as blue. The green line is the 200, and again, and this is 200. It's simple, it's closed, and it's green. But you can see here that when the market moves above the blue line, which I call the trigger, we after this trend to the downside, we stay in between the blue and the green line here for a moment. It tests the green line, which is our confirming moving average. This is our trigger. This is our confirming. If it breaks to the confirming, we should see further movements in the upside, but in this case the market's not ready. It's what I call in between the goalposts. The goalposts are defined as the blue and the green line, the 100 and 200 bar moving average. So we get a movement back to the downside here, and we go below the 100 bar moving average, which gets you out of the trade, but then the market bottoms again and starts its move. This time we get through the green line, the confirming moving average, and we're off to the races. It gives you the signal to go long. It gives you an opportunity to trade against these levels with defined risk and allows you to move to the upside. If you went long right here, what is your risk? Well, you went up to the 200, couldn't get through there, so you could take profit there. But your risk is when it goes through the blue line again here. But why? Because the bias turns from bullish, then turns back to bearish. So that's part of money management, is being able to trade near these key levels and defining your risk. And if you do that, you're able to limit your risk. And if you limit your risk, you're going to be managing your money much better. And that's the name of the game. So continuing on, we move up to the top here, and then we start the correction down. And look at this point right here that comes to the 38.2% retracement of this move to the upside here. And it also corresponds with the 100 bar moving average. Now, folks, I didn't make this chart up. This chart is made up by the market. And the market decided that, guess what? This level was going to be a key support level, a level that you can lean against, a level that you can manage your money against. Why? Because it's a low-risk trading level. What is your risk by buying the market at this level? I don't care what the news is. By buying the market at this level, what is your risk? Maybe to this point right here. Is that a lot of risk? So that's talking about 13. Why don't we go all the way down to the 04 level where the market breaks the 200 bar moving average? We could risk a whole 10 pips on that trade. Is that a low risk trading opportunity for you as a trader? Are you managing your money better by trading near a borderline like the 100 bar moving average, like the 38.2% retracement? Of course you are. Of course you are, folks. That's what you look for in the market, is those low risk trading opportunities that allow you to take advantage of the market. Now, I am getting a report here, folks, that the data is better than expectations. We're seeing ISM non-manufacturing move up, and so we are seeing a little move down in the euro versus US dollar. We have good support down here at the 04 level and the 10 level. We also have the factory orders, which came out better than expected. So far today, we've had a little bit better than expected data. Doesn't necessarily mean the Fed's not going to do what it's supposed to do. Getting back to the show here, what we know here is that if you manage your money properly, what you're going to find is that if you trade near key borderline levels, there are 150 and 100 and 200 bar moving average. The blue line is 100, the green line is a 200, and it's a simple moving average. So if you manage your money properly, and if you trade near key borderline levels, like the 100 bar moving average, you're able to limit your losses. If you can limit your losses and take advantage of trend type gains, you have a chance, or a better chance, to have your account value grow. Let's go to this example right here. If you were a buyer here against the 38.2% retracement and the 100 bar moving average, and you risked 12 to 15 pips on this trade, maybe below the 04 level, the 50% retracement line, that is, well, if we look at these squares here in this chart, that's about one square of this move. Now, the gain that you could have in the next, half hour or so would have taken you up 1, 2, 3, 4, 5 squares to the upside. With how much risk do you have in this trade, folks? The thing about a trending market is they're fast and they're directional, and they move in the right direction. All you have to do is get great trade location, and this is great trade location. The market moves to the upside here and allows you to risk a little to make a lot. That is money management. That is a part of money management that people don't necessarily think about, is the location of their trades and how they're going to leverage that location when they have it right. When they see the market starting to go up here, they're feeling very good about their trade location here, and they can even move their stop up to break even if the market gets up to this point right here, and risk and allow your market to go in the direction in a fast motion to the upside, and that's the essence of good, proper money management. So if we move along in this trade, we can see here that the market moved up to this high right here, and then we corrected again, and we corrected back toward the 100 bar moving average, back toward, if I can get this right, back toward the 38.2% retracement. Gosh darn it. Wouldn't you know it? So I'm going to have to zoom in here. And there we go. All right. And we had another opportunity here where you could bought the market near the 38.2% and the 100 bar moving average, and we get another surge to the upside, and then the market transitions from trend to non-trend, and that's what we're seeing as we consolidate into the FOMC decision. But this trade from yesterday, or this opportunity from yesterday, is all about what you as a retail trader should be looking for, what you should be trying to find. And it doesn't necessarily always work out like this, of course. And but in a lot of instances, what you'll find is that if you can find that good location and you get lucky, and I do like to say that good traders make their own luck. And what I mean by that is that you are able to find those key levels that the market also sees. And if the market sees it, it almost becomes a self-fulfilling prophecy, and it starts to move up. Sometimes in the 5-minute, I look at the hourly, I look at the daily chart as well with the instant accuracy. So so successful traders make their own luck. They allow the market to move in their favor. They limit their risk to a small amount, one box here for the potential of 1, 2, 3, 4, 5, or 6 boxes. And that's a good risk-reward ratio that allows you to increase your account balance if you're able to stay on that trend. So are we all in sync with that idea? So we now know that the part of money management is being able to get good trade location, understand your risk. If you can understand your risk, you have a much better chance to make a good multiple of what you're risking on the trade. So that's part one of money management. Now I'm going to take the screen off here. I'm going to bring up my Excel screen instead. And so let me put that up. And we're going to go through some simple examples of understanding a little bit more about what money management means in the context of the risk that you take versus the reward that you take, reward that you gain on a trade. And the one, excuse me, as I mentioned before I started, I am the Chief Currency Analyst for FXDD, or Sean mentioned that. I'm Chief Currency Analyst for FXDD. So we are a Forex broker, and what we see, what that allows me to see is what traders do right and what traders tend to do wrong. And there are certain tendencies that we are able to see, and I alluded to one a little bit earlier, and that is that there are certain traders that come to me and they don't realize what those big losses can do to their account. They also don't realize that if they're going to risk a certain amount of percentage in their portfolio on as a risk in there for each of the trades, they don't understand how they have to try to stay on the trend and be able to get a multiple of that risk as far as the reward goes. And these are things that keep retail traders from having their account balance grow. What we do know, folks, and I don't think it's any surprise, is that about 70% of you in this room will lose money trading Forex. The good news is you are here today. You are here listening to Ed Ponzi, here listening to me, here listening to the other speakers, because you have an interest in learning about how to do it better, how to turn the tide back in your favor. And so so those transgressions that I speak of from our retail traders may not apply to you after today's lesson, or because you're out here trying to learn. Now, but it is so important to manage your risk, to understand your risk, to define your risk, and to keep that risk to a very small amount. Again, put your thumb and your index finger together and have this visual of, I'm going to risk a small amount to potentially make something bigger, and widen your fingers at that point. It's I think of visual as something important, and since you can't see me, you can visualize me doing that actually to the screen right now. But what I want to demonstrate now is the actual numbers, the numbers of what would happen if you risked a little and you potentially made a lot. And I have 7 different scenarios, and it kind of goes through 7 different types of traders, if you will. And so the first scenario here is, we're going to assume that these traders all do 50 trades, and that could be over a year's time, it could be over a week's time, it could be over a month's time. What I do suggest is that you as a trader, make sure that you pick your trades out, pick your spots out like we went through in the example, and find those levels where you have good risk-reward potential, where you sometimes can even have 2 things like a Fibonacci retracement and a 100-bar moving average as a level to lean against. And if you do, you're going to find yourself that you're able to have some good winners, have some winners that are going to give you a multiple of your potential risk on the trade. So in this scenario number 1, let's assume that we have a win-loss percentage that is only 33.3%. So every trade that you win, you actually lose 2 trades. So some of you may have a higher percentage than that. Some of you may have a lower percentage of that. But I think that's a conservative number that all traders should at least strive for, is to be right once and be wrong 2 times. So let's see how the numbers work out if that on each of those trades you risk 3% of your account balance. Now, why 3%? Well, proper money managers, hedge fund managers, people who are in this business, they don't go out and risking 10% of their account, taking an account from 10,000 to 9,000, or 20% of their account, taking an account from 10,000 to 8,000, and just saying, oh well, that's I still have 8,000 more to trade in my account, I can make it all back. No, what they will look to do is risk a small amount and look for those opportunities to make a bigger gain. Trends are your friends. Trends are directional. Trends are fast. And that's what they're trying to do, whether it's on a 5-minute chart, an hourly chart, or a daily chart. It doesn't matter. What they're trying to do is limit that risk and look for the multiple gains. So in this case, or in this example, I'm going to take things very slow and assume that we're going to risk 3% of the account balance, and we have a hypothetical $10,000 account, and our target gain is going to be 7%. So this is, twice plus a little of the risk that we're taking on the gain. So we know that with 50 trades, we're going to have 17 winners and 33 losers. So trade 1, we're going to start off with $10,000, and we're going to assume that we make a 7% on the first trade. So our account balance goes to $10,700. We move that down to 0.2 right here, and we're going to take the $10,700. We're going to risk the same 3%, and in this case, we get stopped out and we lose 3% of our account. So we lose $321,000. We go to $10,379 in our account. We move that over to trade 3, and we find another opportunity where we're trading. In this case, it doesn't work in our favor. We lose the same 3%, $311.37, and the account goes back down to $10,067. We're only up a small amount. So you see that the pattern here. The next one is the one that we actually win. We make back our 7%. So we have 1 winning, we have 2 losing, and we're able to pick our spots and be patient in our trading, and that allows us to risk a little because we're trading at a borderline level and potentially make that gain that we saw in that euro-dollar chart that may make 2 of those in this case, we're only making 2 plus a little of those boxes that we were risking on the trade. So assume that the risk on the trade, the stop loss, that one box that we were looking in our chart is 3%, and that the gain would have to be 2 plus a little bit of the boxes. That would be our target on the top side, and we structure our trades toward those goals, and we look for those moves of that magnitude. And if we were in our hypothetical example, if that happens, if we're able to do that scenario, how does it all pan out? So I'm going to scroll down to the 50th trade, 49th and 50th trade, and you can see here that on the 49th trade we made the 7%, so we're up 19.2%. On the 50th trade we lost our 3%, so we're down to 15.6. So this is about how you would end up after your 50 trades. And in this case, you're winning trades every third trade, with total 12,566. You're losing trades, but only lose about $300, $350, $360 along the way, and we lose 11,005. We'd make $1,560 on our account value, which is a 15.6% gain on that account value. And some of you may be saying, well, that's not enough. I thought we'd make 3 or 4 times the amount of money in our trading Forex. After all, this is risky, blah, blah, blah. Well, the rates, in fact, are 0.25%. We're going to, the 10-year bond yields are in the 2 handles. 15% is not a bad return. In fact, I can get in trouble for saying that you can make 15% by just doing a simple thing. But the numbers are just, I won't get in trouble. These are just hypothetical numbers, but the numbers do suggest that if that's what you do as a trader, if that's what you focus on as a trader, you will start to see these types of progressions. Progressions higher. And that 15.6% return on those 50 trades is much better than the 70% of the traders who lose money. Those 70% of traders who lose money. You have to look at yourself and say to yourself, okay, what am I doing right now? And if you're not doing well, if you're losing money, if you're losing a little, if you're losing a lot, maybe you should start thinking in terms of, all right, how am I going to manage my money properly by finding good trade locations? How am I going to manage my money properly by using good risk management, risking 3%, trying to look for those 7% gains in the exam, 7% gains in your account. So let's go to scenario 2 and take a look at what would happen in this case, in this scenario. And in this case, what we have is the same 33%, and we lose the same 3%. And we in this case we only get a 6% gain on our wins. So we're only able to just 1% less than the 7% that we earned before. And rather than going through the example, we'll just go down to the bottom here, and we can see here that overall pretty much broke even on the trade, so or on the 50 trades. So for one little measly percent more, squeezing that trend a little more, finding that trade location that's going to allow us to potentially make the 7% or more on the trade, it actually costs us 15%, 16% on our account value. And so it illustrates the importance of staying on the trend as far as you can, of managing the trade as you go along and allowing that market, that trend, to work in your favor. So always try to get as much as you can out of the trade. We can do a show on exiting trades. I have specific thoughts about that, but it's really not the focus of this this show here today. But what you should do as a trader is certainly manage your risk as you have your winners, and also look for those opportunities to exit trades with a reason, just like you enter a trade with a reason. But I don't want to transgress. But we can see. But the importance of this scenario number 2 is to show the effects of just a 1% change in the returns that you get on your gains can have a material effect on the percentage wins after the 50 trade scenario. Now we're going to go into scenario 3, and scenario 3 takes our winning percentage up to 50%. So now we start to work better at finding good trade location. We're patient in our trades. We look for those opportunities like illustrated in the euro-dollar example. where we had the 38.2% retracement and the 100-bar moving average at the same level. And in this case, so we're able to up the gains in our trades to 50%. So we actually lose one and we make one. That's pretty good. But in this case, since we are we increase the win percentage, we also decrease the average target gain in our hypothetical example. In this case, we only make 4% on our gains, on our average gains over that period. And so we're risking 3%, we're making 4%. And in our simplified example, we alternate between gains and losses. So we start with a 400 gain, we lose 3%. We start with another 400, we lose or another 4% gain, we lose 3%. And what we find is we have 25 wins and 25 losses, and our average win is 445, our average loss is 347. And if we go scroll down to the bottom, what we can see here is that if we increase our percentage gains to 50%, it has a material impact on the amount of that we'll make in our account. In this case, we can actually make 24.5% just by having a 3% loss and a 4% gain and keeping those big losses out of our trading position. And that's a pretty good, and again, another pretty good return on the amount that you can possibly make in your account. So this is a goal. This is a different idea, a visual, something that you can grasp on, something that you can understand as far as numbers go, as far as what you need to do in order to see your money grow as a trader in your account. Now we'll progress to we'll move forward to scenario number 4, and in this case we have the same numbers that we had in scenario 3. I'm going to scroll back here just to show you. We have 50%, we have 50%, we have 3% loss, we have 3% loss, we have 4% gain. But in this case, every 10th trade, and if this is over a year's time period, every 2.5 months, or every 5 times a year, what we have is an oversized loss. That is, we allow a trade to get away. Maybe we trade the unemployment number and the number goes against us. Maybe we don't define our risk. We buy a level that's well away from a moving average, well away from a Fibonacci retracement line. We don't define our risk. We become stubborn with the position. You know the reasons why and how you lose a lot of money in the market. And those reasons, are generally greed, generally not defining risk, generally stubbornness that involves a fundamental perspective that doesn't go your way because you can't see all the fundamental news that's happening. And all this leads to, well, every 10th trade I lose $1,000 or 10% of my account, of a $10,000 account. And these are those traders that come to me and say, well, I just lost $1,000. I got caught on this trade and I couldn't get out. That means that you didn't define your risk and you didn't understand your risk and you didn't put your stop loss in, and that's why. And you didn't understand the increase in risk because of this key economic data that was coming out. It's your fault, and it was more of a gamble, and you didn't do it right. You just didn't do it right. So admit it, but you have to avoid it. But let's see the effects of having this 10% loss just 5 times a year in 50 trades, what that does to your account. And if you look at this, these numbers, and you look at the results, at the end of the year, at the end of the 50 trades, you're down 14.4% in your account. You have a 9,573 gain on all your positions, but you lose 11,000, you lose 1,400 in your account, and you're well on your way to starting to have your account move toward liquidation, And although you're successful 50% of the time, it's those big losses that really affect your account, and those are the ones that you really must avoid if you're going to be successful as a retail foreign exchange. Moving on to scenario 5. In this case, what we're going to look at here is if you only write 33% of the time and you have that 10% oversized loss every 10th trade. In this case, you can lose 51% of your account. So the percentage of wins obviously is, and the oversized losses. If let's say you start to press in the market because you're not winning, as often as you think, and you start to press on these big trades, taking on more risk, not understanding risk, not defining risk. What you often find is that the more risk you take, the more money you're going to lose, and in this case, you lose 50% of your account rather quickly in over those first 50 trades. Scenario 6 takes a look at the situation whereby not you've learned your lesson, that you understand about getting those trend type gains when you can. And if I can go back to the visual of our trade in the euro dollar where we risked 1 box and we had the potential to make 5 boxes, well, that type of gain would equate to something like this, where you make 10% or 5 times the amount of the amount you're going to risk, or 3 times the amount of the amount you're going to risk, and you're able to do that only 5 times in the course of a year, where you pick your 50 trades or periods, pick your 50 trades, and you're very patient with your trades, and you're able to ride the trend for 5 times. In this case, we're only right 33% of the time. That means we're wrong twice, we're right we're wrong twice, we're right 1 time, but on those times that you're right, you're able to ride the trend and able to win on those gains. And in this case, you can see how the returns move up to around the 20%, 18.6 to 22.2, and so that, with only being right 1/3 of the time, that is the effect of being able to follow the trend and gain the trend. Our final example before we get to the questions here is scenario 7. And in this case, what we see is that you can up your percentage to 50% and move yourself toward being a very successful trader that's right half the percent of the time by being patient in your trade location, by looking for those key opportunities, and you're able to ride a trend 5 times a year and make 10% on those gains. That is, make 3 times or so the amount that you're going to risk on the trade. Then you'll see that these returns actually start to get pretty hefty, and you start to make around 60-70% on your money, and that's the essence of a successful trader. So we all are somewhere in between these areas here, these 7 scenarios here. I've outlined those traders who are average. I've outlined those traders who are successful. I've outlined those traders who don't manage their risk properly, and then there are the other traders who just trade willy-nilly, who don't find those key borderline levels, who don't find those levels where they can define their risk, and they end up losing. Their profit graph here is going to be much more sporadic. They're not going to have the consistency that we've shown that a proper money manager will and a proper trader will look to have when they trade successfully. So in summary, what we know here is that there are 2 types of 2 important things to proper money management. The first is to be able to understand and define your risk, and that risk is defined by doing things like trading near key borderline levels, as we've seen here in the euro-dollar chart, trading near moving averages, trading near Fibonacci retracement levels, and that allows you to define your risk and keep your risk to a minimum, keep your risk to a box, have the potential to make 1, 2, 3, 4, 5 times what you risk on the trade, and this is what you're trying to do as a trader at all times. The second most important thing is limit your risk. Make sure you limit your risk to something in the area of 3% on any of your account value in the market. With 3%, you're not worried. You should really be concerned about 100-to-1 leverage or having 50-to-1 leverage. That should be plenty of leverage for you in order to allows you to make money. And if you're able to limit that risk to something like 3% on every 1 trade, and then look for those opportunities where you can make more than 3%, 4%, 6%, 7% of your money, then you're able to have your account balance grow, and then all you have to work on is being more successful a greater percentage of time. And if you can be successful even 1 out of 3 times, you can make a decent return trading foreign exchange. If you can up that percentage to 35, 40, 50%, you're going to be even better, and you're going to be one of those 30% of the traders who make money and not one of the 70% who actually lose money. And that's the name of the game, folks. It's simple. It's easy. It's in the math. It's in how you approach the market. Follow these rules, and you'll be able to become more successful. So, with that said, Trader Cisco says, so true. I know Trader Cisco. He's my friend. Thanks for coming in, Scott. I really appreciate that. And if there's any questions here, I'll be happy to answer your questions. I also can go through some of my scenarios for the FOMC. If you want me to do that, I'll do that as well. Just give me a yes, and I'll go on. Maud, how much time do I have? When do I have to sign off here? Okay, I hear FOMC, so I'm getting the FOMC. Here's my take on the FOMC. Hold on a second. My take on the FOMC is, what the market expects. I think the Fed, despite the better data here today, what we have is we have 9.6% unemployment. That's not going to spur economic growth. It may spur potential growth. We saw consumption move up by 2.4% or so in the third quarter, or 2.5. I can't remember which one it was. But what 9.6% unemployment is, you're going to have these spurts where you're going to see some growth in consumption. And then you're going to have times when we're not going to see the growth in consumption. So you're not going to, we may not go into quote unquote a recession, but 2% growth is not going to get us down, get the employment people working. That's going to allow the engines of the economy to continue on. So that's what the Fed is facing for number one. The other thing is the inflation. In their last statement, they said the mandate for inflation was, they were failing in their mandate to have inflation between 2 and 3%. Most people think, oh well, isn't low inflation good? No, low inflation or negative inflation is not good for economy. People put off purchases. Stock markets have trouble, or they could have a bubble as well. You can actually have a bubble in a stock market and income gets deflated. So it's kind of unsure. It could go either one way or the other, depending upon where we are and what the focus is on the market. But the Fed is really concerned about the deflationary effects, and part of that also has to do with the housing market. The housing market continues to be a drain. We saw that yesterday in a reality check report that came on CNBC that to get rid of all the foreclosed properties at this standing start right here, it'd probably take 40 months. That's assuming no increase in foreclosed properties. Well, the longer you go on with people losing their benefits, their unemployment benefits, the better chance that those people are going to, give up foreclose, have to be foreclosed on their property, and that's one of the issues that the Fed is concerned about. So they need to. Is the camera off? Okay, put the camera back. Let me see here. Camera off, camera on. Do you see the chart? Up. So with all that said, the FOMC is they're going to announce the $500 billion, or that's what I expect them to announce here today. Whether or not they keep it open-ended for additional easing, because we really don't know what the effects are going to be. What is the effect of the dollar going to be? I expect it to be down, but we've been talking about this for some time, so we don't know if it's already priced into the market. We won't know until the numbers do come out and we see the change in the price. So with that said, why don't we take what I like to do when we have these risk events is to define the bullish and bearish bias, just like I did in my report, understanding where the market is bullish and where the market is bearish. And just taking a quick look at the euro, we're in this triangle formation here after this bull flag here. So is that a bullish bias? Yes, it is. We broke above the upper flag here yesterday, and today we came down and tested the bottom side of that breakout, and we successfully tested that that level and moved well to the high from yesterday. We aren't necessarily the market hasn't given the full go ahead here, but if the market should be able to get above this high from earlier today, the high from yesterday, it's going to open the door for the next level at the 140.78 level, 79 level, which is the high. That would be our next target along that way. So anything that goes above this high here, right here, is going to be bullish. We're going to be looking for the next target. The next target will become this 140.79 level, and then the next target, next key level, will become this channel trend line here. This channel trend line is going to come in around the 140.06, maybe the 140.10 level, and each of these targets along the way, Alex, would it be a fake breakout? Each of these targets along the way have to hold the support. So if we get to this high right here at 58, I would put my stop in at probably around the 48 level or 50 level and look for the continuation and the confirmation through the 79 level. This is why you have targets. This is why you prepare for a trade, because you have to see the market react to not have the fake breakout. If you have the fake breakout, Alex, that's the 3% loss that you have on the trade, but you're doing it after the report, so you don't have the event risk. You now have the market risk, which is what we look for to keep our risk to a minimum. So you have to, if it fakes the breakout, that's part of trading, folks. That's what we do this for. We have to risk something, and that's part of trading. But what you want to do is see the market rotate, see the momentum. If the market breaks this high, we should see higher prices. I call it the if should rule. If it does this, it should do that. And when we should move through the 79 level, we should go and test this trend line up here. Now this line is a key level, and I would expect that we'd see profit takers up at this level. Why? Because 1, 2, 3 different times we've tested that level. Yesterday we got within 8 or 10 pips of that line and came off, and I would expect that we'd see some profit takers from this move up at that level. If we don't see the profit takers and it goes through, don't fade that. That's another indication that the market is going higher, and then we're heading up toward the high price that we saw in October of 2010. So that's how I play the upside. On the downside, what we know is the 140 level is a key level for the euro. We're kind of too close to that level. We reached a low here yesterday or today at the 91. We also have this trend line in the 100-bar moving average on the hourly chart. All these levels come into play. This trend line comes from this high to here. All these levels are your target levels on the downside. So when I trade a key release like an FOMC, and it's the same, I use trend lines, I use Fibonacci, I use moving average lines. I'm going to start looking for my targets by looking at the obvious levels along the way. And if it breaks through one, it's got to get to the next. If it breaks to the next, it's got to get through the next. And if it breaks through that, it's got to get to here, it's got to get to here. And this is the essence of a trend. This is how you stay on the trend and move in that direction. So there you have it, a look at the FOMC and a look at the, how I look at the euro. Do the same type of analysis in the other charts that you have. Let's see, any other questions here? If one is backtesting a strategy, how can you determine what the percentage wins to losses is? Well, by backtesting, most of the backtesting backtesting that you can do will determine the win percentage, the win-loss percentage. So it's in most of the, and if you're just doing it manually or whatever, or let's say you're just doing very crudely that you would go along here and in a demo account, then just count up the wins and losses and do it that way. There are some backtesting software out there that you can buy. I think there's one called Forex Tester or something like that. That's kind of crude, but it does the job. If you want to take a look at that, it costs, I don't know, $150. How would you advise to trade to make a living rather than building a trading account? That's a good question. You have to start off with a lot of money, and here's the thing, folks. People hear about investment managers who make X amount of $1 million trading, and they start off with X times X amount of money trading, of their profits trading. It's all in the zeros that you have in order to trade. But what we know from a historical standpoint is that there are this bell curve of traders, and we also know that there's this return that is inherent in the markets, this percentage return, and to make the high percentages to where you can make or to make a high absolute value of, or the value of your account going up to where you can make a living off of it, you have to have a lot of equity to start off with. It's unrealistic, and I can't say that there are a lot of traders in this bell curve of traders who make hundreds or 200% of their money trading. That's just not. It just doesn't happen. The best way to make the most amount of money, and that's my mission statement. My mission statement in trading is to make the most amount of money with the least amount of risk. And I gave you an example of defining the risk, to keep the risk to a minimum. But to make the most amount of money with the least amount of risk in any market is to trade the trends. The trends are fast, the trends are directional. If you can catch a trend and stay on a trend, you have a better opportunity to make the most amount of money. I'll go back to the period in September of over a 1 month period here. In this chart, this is a trend. This held the trend line. This held, if you want to look at a 100-bar moving average, look at the 100-hour moving average in this chart. Break above the 100-hour moving average, move to the top trend line, test the 100, test the 100, move back up to break above, fail, use that level, that trend line, come back down, test the 100, move back above, move toward the trend line, come up to the test trend line, test the 100, test the trend line, move back up, test the trend line, move back down, test the moving average, test the trend line, and then the market starts to non-trend. That is where you make the most money, folks. And to say that you couldn't make a large percentage in your account if you're able to follow, you could have followed. There was a question about counter trends. Yeah, you can trade a counter trend right here. You can trade a counter trend when it fails at the top trend line of this channel right here, and trade this counter trend. Trade this counter trend. Trade this counter trend. Trade this counter trend. Those are all counter trend opportunities. Why? Because you can define your risk. If the market goes, if I trade the counter trend at this point right here and the market goes through here, I'm out. If it goes here, I'm out. Why? Because we broke above the trend line. If the market comes back down below the trend line and I see this part right here, I'm in. I'm selling. I'm trading the counter trend. Losing trade. They don't all make money, folks. But what you have to do is you have to keep that risk to a limit and go from there. I hope that answered your question. That's draw it down and say. Surely a few big risk trades would be winners. This is being recorded, by the way. Surely a few big risk trades would be winners. Yes, we showed that, Manoj. Why to keep 10,000 in your account if your maximum drawdown is let's say 1,500? Well, you need the margin. You don't necessarily have to keep 10,000 in your account, but make sure that you have enough margin so that you don't get liquidated. You know what I mean? So I don't know. Whether you have 10,000 in your account or you have 10,000, you have 5,000 in your account, and you're risking 3%, and you have 5,000 in reserve, in your checking account, that's fine with me. I don't care. Just 10,000 is your risk capital that you have that you have available to you. Glad to be here. Glad to have you here. Scenarios for I gave you the scenario for the FOMC. I hope that made sense. Hi, Greg. If trade per exposure risk around 100% in any return at 70%, do you suggest is a good risk-adjusted return for a fund trader, trader that trades investor money? Yes, it is. There are people that are better and there are people that are worse. But what are the returns that people can get alternatively either in the stock market? You can make better money in the stock market. trading foreign exchange, they say it's more volatile. They say it's more volatile because it self-corrects itself, in my opinion. They say it's more volatile because the euro can go down to 118.76 from this point right here all the way down to 118.76, and then it can go back up to 140. Now we know, and so that is considered, oh well, this is volatile in the market. But you also get trends in this foreign exchange market that allow you to take advantage of that. You know, you want to make as much as you can, but I don't think anyone would balk at a 17% return if you were managing their money. I get worried about, I'm just saying, I get worried of returns when people say, oh, I can guarantee you 100% return. Right. It just doesn't happen, folks. Don't worry. Those type of returns have a lot of risk, and typically they, those types of returns are built off of non-trending markets where you buy low, sell high, in a very in a range type trading system. And then when the market trends, they get killed, and then they start all over again, and they say, well, we started from scratch here and we made money in this non-trending market, and then it trends again and they made 100%. I don't know. Show me the guy who made 100%. They're very few and far between, my opinion, and from what I see where I'm at. Okay, we are at 10:58, and I think that is the end of my show. I want to thank, if you want this Excel file, I would be happy to send it to you. Send me an email at greg@fxdd.com. If you have any comments in regard to this presentation, if you good or bad, I accept all comments, good or bad. Send me an email at greg@fxdd.com as well, and I'll be happy to send you the Excel spreadsheet. And from what I understand from Vicky and Adinda and Maud, this will be brought taped, so you'll all be able to listen to it again at your leisure. I want to thank the people at FX Street for once again providing me the platform to be able to educate you and hopefully make you a better trader in the long run. And so until next time, I look forward to I look forward to that. But until next time, good fortune in your trading. Be careful as the numbers of the Fed meeting this afternoon, and always understand that there's always another trade out there, folks. Make sure you define your risk and you use proper money management, and you'll be much better. Thanks a lot. Take care, everybody.